Hey investor friends, I'm Michelle Markey, and today I'm going to talk about my takeaways from the legendary investor and CEO of Berkshire Hathaway, Warren Buffett's annual letter to shareholders that just came out this February, and it's for last year of Berkshire Hathaway's performance in 2023. And there are so many beautiful things in this letter, including Buffett's tribute to his partner, Charlie Munger, saying that he was the architect of Berkshire Hathaway, as well as a lot of wit and wisdom from Buffett himself throughout this letter. So if you also enjoy studying some of the best investors, I hope you'll like and subscribe to my video and YouTube channel, because I'm dedicated to doing the same, of learning from some of the best investors that are talked about in this annual letter. And you'll be surprised at another great investor that Buffett talks about, who you might have never considered before until Buffett talked at length about this investor. So to learn more about who that is, hope you will stick to watching this video. And the first thing I want to say is Buffett starts out the letter not with Berkshire Hathaway's performance over the last several years, but he talks about Charlie Munger and how he died on November 28, just 33 days before his 100th birthday. So I feel like that's incredible how Buffett honors the legacy of Charlie Munger. And I definitely miss Charlie Munger. As soon as I heard the news, I also shared a little tribute video to Charlie of a lot of things that I learned from him. And I think that if we want to grow as investors, we would also do well to learn from Charlie. And some of the things that Buffett reflected on with what Charlie taught him include the fact that a while ago, Buffett made one of his biggest mistakes in purchasing the company Berkshire Hathaway, and Charlie Munger, who only took up money management at the tender age of 38 years old, advised Buffett that he would help him to correct this mistake that turned out to be an incredible company and investment. So Charlie Munger gave Buffett a lot of incredible lessons, including how even though Buffett learned a lot from his mentor, Ben Graham, he said that you should basically abandon everything you learned from your hero. It works, but only when practiced at a small scale. And what I take away from that is you can't always treat every investment as though it's a cigar butt. You have to actually sometimes invest in what Charlie Munger said are wonderful businesses at a fair price, rather than fair businesses at a wonderful price. So keeping that in mind, that helped turn things around at Berkshire Hathaway. And also another takeaway I had is that Charlie Munger told Buffett a bunch of things on how he can improve as an investor, but he said he never reminded him of his mistakes. And also Buffett reiterates Charlie's impact in saying that he should forever be credited with being the architect of Berkshire Hathaway. So with something like that, Charlie was just an incredible investor, and he didn't even start out being invested in Berkshire Hathaway. So maybe to me, that kind of explains why Munger may not have had nearly as huge of a net worth toward the end of his life as Buffett has. So Charlie Munger may have had around $2 billion of a net worth. And I say only because Buffett has over $100 billion of net worth. So it's interesting how it seems that Charlie was not as invested in Berkshire in the beginning, but I'm sure he invested over time, and he had plenty of other investments. So it's not like Charlie or his family were hurting by any means. So moving on from some of the takeaways about Charlie Munger, in the actual annual letter itself, reflecting progress from last year, Buffett doesn't say the usual like he did in a lot of past letters of how much Berkshire Hathaway progressed, but he did have some other significant lessons that I think are valuable to talk about, including how he said that investors who trust Berkshire with their savings without any expectation of resale are the kinds of investors that Buffett is writing this letter to, including his sister Bertie. And Bertie is Buffett's younger sister. He's also talked about his older sister Doris before in some of his letters. And there are a lot of things that Berkshire Hathaway has to report, including there are a bunch of financial figures as regulated by the Securities and Exchange Commission and based on the Financial Accounting Standards Board that Berkshire has to report on, including what he calls the worse than useless net income figure that quickly gets transmitted throughout the world via the internet and media. And as opposed to that, Buffett says that at Berkshire, their view is that earnings should be a sensible concept that Bertie will find somewhat useful, but only as a starting point in evaluating a business. So he talks about how Berkshire likes to focus on operating earnings, where the story that this operating earnings tells is that they earned $27.6 billion in 2021, $30.9 billion in 2022, and $37.4 billion in 2023. And so he says the primary difference between the mandated figure of net income and the operating earnings figure that Berkshire prefers is that they exclude unrealized capital gains or losses that at times can exceed $5 billion a day, with his emphasis added. So what he's saying is you could get a really wrong impression of how well Berkshire is performing if you just focus on the net income figure, because Berkshire has about half of its market cap in equities, and that's pretty significant in that when you have unrealized capital gains and losses in this huge component of Berkshire's worth, that can fluctuate and kind of give you a wrong impression of what Berkshire's net income might be for any given quarter or a year. So he encourages shareholders not to focus on that net income figure as much as what he likes to tell shareholders to focus on, which is the operating earnings he talks about throughout this letter and historical letters. So he can't remember a period since March 11, 1942, the date of his first stock purchase, that he has not had a majority of his net worth in equities, specifically US-based equities, as he emphasizes. So he says that so far, so good. America has been a terrific country for investors. All they have needed to do is sit quietly, listening to no one. So if you think about that, if you've been sitting in investments for as long as Warren Buffett has and Berkshire Hathaway, you would not be trying to buy and sell a lot of stocks. If you want to have reliable compounders that will deliver incredible wealth to you as it has to many of Berkshire's shareholders. So keeping that in mind, he says, it is more than silly, however, to make judgments about Berkshire's investment value based on earnings that incorporate the capricious day-by-day and yes, even year-by-year movements of the stock market. As Ben Graham taught me, in the short run, the market acts as a voting machine. In the long run, it becomes a weighing machine, referring to the companies that deliver real value will actually compound in their market value and thereby your share in those companies' market cap. So keeping that in mind, he also talks about what Berkshire's goal is, and it's simple. He says that we want to own either all or a portion of businesses that enjoy good economics that are fundamental and enduring. Within capitalism, some businesses will flourish for a very long time, while others will prove to be sinkholes. It's harder than you would think to predict which will be the winners and losers, and those who tell you they know the answer are usually either self-delusional or snake oil salesmen. So at Berkshire, we particularly favor the rare enterprise that can deploy additional capital at high returns in the future. Owning only one of these companies and simply sitting tight can deliver wealth almost beyond measure. Even heirs to such a holding can, sometimes live a lifetime of leisure. So he put the word there because he's kind of sort of poking fun at how, if your ancestors make great investing decisions, you as an heir can benefit beyond your wildest dreams financially into the future. So he says that they hope these favored businesses are run by able and trustworthy managers, though Berkshire has had its share of disappointments. And he quotes a comptroller of the United States in saying, never deal with a rascal under the expectation that you can prevent him from cheating you, and also that sincerity and empathy can easily be faked. So I think that Buffett's making a bit of a comment on some managers that might have hoodwinked Berkshire in the past, and you got to be careful about those rascals and not let them run your businesses. If you know that a business will be heavily influenced by how a manager performs. So oftentimes, like Buffett and Munger have talked about, they want to find a company that's sort of idiot proof, that any manager could run it and the business will remain mostly intact no matter who's running the show. And also he said that this combination of both, the competitive advantages of a business as well as having a good manager in place are the two necessities he's described for acquiring businesses. And that's been their goal. So they sometimes miss some opportunities, but another one has always come along. However, he's also couching that with saying that those days are long behind us. Size has did them in, though there's also been some increased competition for business purchases. And Buffett continues in saying that Berkshire has now the largest GAAP net worth recorded by any American business of the tune of $561 billion. And to put that in perspective, the overall net worth of the other 499 S&P 500 companies should come out to about $9.5 trillion for 2023. So Berkshire now occupies nearly 6% of the universe that it operates in. And he kind of says that outside of the US, there are essentially no candidates that are meaningful options for capital deployment at Berkshire. All in all, they have no possibility of eye-popping performance. So we should keep that in mind with trying to see how much Berkshire can currently grow at its present size of almost $900 billion. And it's interesting because they probably bring in about 10 times as much revenues per year as a company like Nvidia does. And yet Nvidia is at a $2 trillion market cap. So he's trying to tell investors that you can't expect Berkshire to have gangbuster growth numbers like some big tech companies maybe might seem to inspire, but you can have faith that Berkshire will be a reliable deployer of capital when and if there are investment or business opportunities that they can invest in. So we should keep that in mind, and that Berkshire will have somewhat better prospects than exist at most large American companies. I like how he wrote, by both luck and pluck, a few huge winners have emerged from a great many dozens of decisions. And a lot of their longtime managers just think of 65 as yet another day. Like they don't see it as a time when they should retire. They just keep working until ideally over 100 plus or so, if Buffett could have his way. And he said that Berkshire benefits from an unusual constancy and clarity of purpose. And he says, while we emphasize treating our employees, communities, and suppliers well, who wouldn't wish to do so? Our allegiance will always be to our country and our shareholders. We never forget that. Though your money is commingled with ours, it does not belong to us. So I think he's saying a few things here. He's showing how much of a civic duty Berkshire has to America, as well as he's saying that while you as an investor and saver might have your money invested in Berkshire, he knows that that money doesn't belong to them. So Buffett is not about to run out and pay himself a huge pay package just because he's the manager of Berkshire. He's going to treat your money with respect. And also it kind of reminds me of the concept of float that Buffett has talked about in the past, where a lot of people pay their car insurance premiums to Berkshire and Geico, but that doesn't mean that Berkshire owns that premium. They invest that float knowing that they'll have to pay out for a car accident someday. So they hold on to it to make more money with, knowing that they'll have to pay some of that out to expenses and things that the business might incur. So keeping that in mind, Berkshire should do a bit better than the average American corporation, and more important, should also operate with materially less risk of permanent loss of capital. Anything beyond slightly better, though, is wishful thinking. So to date, Berkshire Hathaway has been up about 14%, and it's been incredible because Berkshire B shares were at about $360 a share, and now toward the end of February 2024, they're around the $410 per share mark. So it's interesting to see if that's a reasonable level of growth to expect. I think Buffett in the past may have said he expects maybe around 10%. So if Berkshire can achieve that within a year, that would be pretty good. So he said that markets can and will unpredictably seize up or even vanish, as they did for 4 months in 1914 and for a few days in 2001. If you believe that American investors are now more stable than in the past, think back to September 2008. Speed of communication and the wonders of technology facilitate instant worldwide paralysis, and we have come a long way since smoke signals. Such instant panics won't happen often, but they will happen. So I think that's very telling, and you'll see that Buffett mentions 2008 not just once, but 3 times if you read this letter. So I see that as a bit of a warning sign, because he continues, Berkshire's ability to immediately respond to market seizures with both huge sums and certainty of performance may offer us an occasional large-scale opportunity. Though the stock market is massively larger than it was in our early years, today's active participants are neither more emotionally stable nor better taught than when I was in school. For whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and daily tempts the occupants. So what you should also keep in mind is that he talks about Wall Street and how they seem to want to like their customers to make money, but what truly causes its denizens' juices to flow is feverish activity, because Wall Street makes commission on the more activity and trading people may do. So at such times, whatever foolishness can be marketed will be vigorously marketed, not by everyone, but always by someone. What Buffett continues in emphasizing here is to say, one investment rule at Berkshire has not and will not change: never risk permanent loss of capital. Thanks to the American tailwind and the power of compound interest, the arena in which we operate has been and will be rewarding if you make a couple of good decisions during a lifetime and avoid serious mistakes. So he believes that Berkshire can handle a lot of financial disasters, that when economic upsets occur, as they will, Berkshire's goal will be to function as an asset to the country, just as it was in a very minor way in 2008 and 9, and to help extinguish the financial fire, rather than to be among the many companies that inadvertently or otherwise ignited the conflagration. So Buffett reinforces that Berkshire's strength comes from its Niagara of diverse earnings delivered after interest costs, taxes, depreciation, amortization, unlike EBITDA, which he says is a banned measurement at Berkshire, which I find kind of funny in his ongoing derision of Wall Street things that they like to have, like EBITDA. And he says that Berkshire does not currently pay dividends and its share repurchases are 100% discretionary. Annual debt maturities are never material. And he says that they hold a lot of cash and treasury bills. I think the last I looked up from fourth quarter 2023, it's to the tune of at least $168 billion of cash, basically, which is kind of a lot. And he said during the 2008 panic, Berkshire generated cash from operations and did not rely in any manner on commercial paper, bank lines, or debt markets. We did not predict the time of an economic paralysis, but we were always prepared for one. So even though he's saying this sort of thing being prepared, it kind of makes me wonder, does he think an economic crash or financial crisis could be on the horizon, being that he's talked about 2008 3 times so far? So I think that's a little something to keep in mind. And Berkshire is built to last, which is pretty encouraging. If I were reading this as a shareholder and wanting to feel secure that I feel like I can trust this manager of my investment. So continuing on, Buffett talks about non-controlled businesses that leave them comfortable. And he sings the praises of Coca-Cola and American Express, both companies founded in the 1800s that Berkshire long ago finished investing in, but they still continue to hold and don't envision selling any share. And they just continue to reap a lot of dividend rewards. And interestingly, he mentions Apple, but only one time, which is a little ironic because in the 2020 letter, Buffett talked about Apple about 11 times, I think, from what I counted. And he said things like they had originally a 5.2% stake in Apple with a little over 1 billion shares. And that increased over time. Like, I think in last year's letter, He mentioned how their stake in Apple had been about 5.55%. And so it's increased gradually, not because Berkshire's buying more shares of Apple. They actually sold 10 million shares in the fourth quarter, and that equates to about $1.8 billion. Maybe small potatoes to some, but I still consider that a little significant that Berkshire seemed to sell off 1% of their Apple holdings. But either way, their share has grown because Apple's done a bunch of repurchases of their shares. So that's helped Berkshire maintain a pretty sizable share of the Apple pie, so to speak. And he said that in the past, Amex and Coke had been mismanaged, but definitely not now. Amex's earnings in 2023 considerably exceeded Berkshire's $1.3 billion cost of their long ago purchase, which is pretty cool. Like, if you get to a point someday where you've already been paid back your cost basis in an investment, either through dividends or share repurchases, now you're just milking that gravy and continuing to just get those dividends and then reinvest them in another way like Berkshire's been doing. And he said that all stock repurchases should be price dependent. What is sensible at a discount to business value becomes stupid if done at a premium. So he said that the lesson from Coke and Amex: when you find a truly wonderful business, stick with it. Patience pays, and one wonderful business can offset the many mediocre decisions that are inevitable. And he talked a little bit about Occidental Petroleum and how even though they own a bunch, they don't intend on fully buying it and managing Occidental, but their vast oil and gas holdings are in the United States' interest. So we want our country to not be oil dependent on other countries like what's happened in the past. And Buffett also talked about the 5 very large Japanese companies Berkshire's invested in, named Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. They've been invested in them since July of 2019, and they've done pretty well. They've had unrealized gains of about $8 billion, and their market value was around $19.25 billion at the end of 2023, which is pretty good. And they seem to be doing just fine investing in those Japanese stocks. And what's brilliant, as my podcast partner, Sina Lonehold, pointed out in one of our Investing Mastermind podcast episodes that may be soon being released, if it may not have been put out there yet, but she told me how Berkshire has financed their investment in Japanese yen, and that's kind of given them this sort of currency exchange rate arbitrage that's then led to their investment in some of these Japanese companies. So if that's the case, that's pretty cool how Berkshire has basically been kind of paid to invest, and which is kind of incredible that someone like Buffett has continued to pull something like this off. And I'm just totally in admiration for that Japanese stock investment working out tremendously in Berkshire's favor. And he talked about how a lot of the non-insurance businesses faced lower earnings in 2023. And in comparison, their underwriting or insurance business did incredible. Like, they set new records. And he talked about how their rail business in Burlington Northern Santa Fe disappointed, and what was even more of a disappointment was Berkshire Hathaway Energy. And some of that is because the rail business just requires a lot of capital expenditures. While their investment in BNSF was attractive in 2010, the replacement cost would be something like to the tune of $500 billion and would take decades. So in spite of the fact that it requires a lot of capital to continue to maintain the railroad business, it's essential to America's economic future. So they're continuing to stick with it, but it's not without some of its own challenges, as well as their even more severe disappointment occurred at Berkshire Hathaway Energy. In that case, he talked about how this margin of safety that they once had of fixed but satisfactory return pact has been broken in a few states, and that's caused investors to become apprehensive that these ruptures may spread. And he says that climate change is adding to investor worries, and he mentions how underground transmission may be required, but who a few decades ago wanted to pay the staggering cost for such construction, given the amount of wildfires going on and a lot of environmental threats to the utility and energy business. So he talks about how this sort of relationship between utility companies and states is facing some existential threats, as what happened in California's Pacific Gas and Electric and potentially at Hawaiian Electric. And he says that Berkshire can sustain financial surprises, but they will not knowingly throw good money after bad. So he said America's power needs and the consequent capital expenditure will be staggering. He did not anticipate or even consider the adverse developments in regulatory returns. And along with Berkshire's two partners at Berkshire Hathaway Energy, he made a costly mistake in not doing so. So that's a little bit of a womp situation of the railroads and energy business suffered, but hopefully they will try to right the ship and improve on their margins and so on in the future. And in contrast to that, Berkshire's insurance business performed exceptionally well last year, setting records in sales, float, and underwriting profits. So that's pretty great in that they're doing pretty well at their core business of insurance, and yet sometimes there can be surprises that are almost always negative in the property and casualty insurance business. And when charlatans are involved, the detection is often both slowly and costly. So Berkshire will always try to attempt to be accurate in its estimates of future loss payments, but inflation, both monetary and the legal variety, is a wild card. So a little bit unsure what he means by legal there, but maybe that's like what he's referring to with governmental inflation, if there's a lot of money printing or whatever to cause inflation to occur. And he summarizes the letter by saying that on May 4, 2024 in Omaha, you'll see 3 managers on stage. And sadly, the 4th will be missing, but maybe the spirit of Charlie Munger will be there, because he talked about how you'll see the 4th edition of Poor Charlie's Almanac be featured. And he talks about how, what is it about Omaha that gives a lot of the people who work at Berkshire, like the future CEO, Greg Abel, the insurance all-star, Ajit Jain, and Buffett and Munger themselves that were born and raised in Omaha, what makes them be such good investors? And what I mentioned earlier, another really great investor turned out to be his younger sister, Bertie. She made some investments in a mutual fund and Berkshire Hathaway, but has not done anything with those in decades. And that's led her to become an incredible investor and allowed her the opportunity to make 9-figure philanthropic gifts. So it turns out that Bertie, not because of what Buffett's encouraged her to do, she, with her own sense and her upbringing in Omaha, encouraged her to become the investor she is. So interestingly, you don't need to necessarily have had a leg up on Wall Street. You can just grow up in a sleepy town like Omaha and still become an incredible investor like Bertie and many others have. So with that, it looks like, this Omaha effect is not to be trifled with, because it could be in Omaha's water or air, who knows? But Buffett encourages shareholders to visit yet again in Omaha. So I've made videos in the past about how to attend Berkshire Hathaway. Feel free to check those out. And I know this has been somewhat of a long video, so if you're still with me to the end, I'm really grateful you stayed here. And as always, if you appreciated some of my insights and takeaways based on what I've learned in this Berkshire Hathaway letter, I hope you'll like and subscribe. And if you visit Omaha, I hope you have an incredible time. It's a wonderful experience. I went in 2022 and 2023, and I had an incredible time. So you'll meet amazing investors and people who are like-minded, people who share the culture and values of Berkshire Hathaway, and you'll get to absorb the wisdom of Warren Buffett and Greg and Ajit. And I wouldn't delay if you're trying to set up your lodging and your transportation to get to Omaha, because a lot of things get booked up quickly. So if that helps you, definitely check out some of my blogs on my website, michellemarkey.com, and also my YouTube videos about how to attend, and pay attention to when the proxy materials might come out, because there's a form that you have to mail in that gives you your tickets to attend, and they usually come out about mid-March. So with all that, happy investing. Till next time.